Let's begin with the fact that Americans love to buy. You've got to break into the circle somehow. Americans love to buy. We know that. We had increases in home prices. We had increases in the stock market, along with increases in income. Made us feel wealthy. You see, from the early 1990s right up to the early 2000s, income was taking off, mean income of all households. Real dollars, 2007 as a basis. And we spent at a very steady rate throughout the 90s. And we spent even after income growth tapered off. Now, that's an interesting piece of news that wasn't really carried that much, not really emphasized all that much. Hence, how do you keep on spending if income tapers off? Well, it's a four-letter word called debt. Then debt starts increasing. So in this process, or this willingness on the part of consumers to spend even when income flattens out in the late 1990s, what was going on was we still, because of the obsession with buying, we still had to have the goods produced. That brings the globalization issue into the logic, because we're not a nation of producers. We had to have the products that we wanted produced elsewhere. That brought China and other low-income countries, low-cost countries, and you can see what it did in China's case in particular, in the enormous imbalance of trade with China and how it developed quickly from the mid-1990s on. It just skyrocketed. Now, what did this do? It brought China into the mainstream of a world-class player. They had a huge population, so to build up a labor force of 400 million people wasn't hard because our demand was so heavy. And then China started playing in the world marketplace. You see their GDP just taking off, particularly beginning in the late 1990s. But notice the red line is total foreign reserves. They started buying up reserves from other countries. And the green line is the amount of reserves they're buying here, namely covering our debt. So not only are they producing our goods, they're covering our debt. So big increases, the whole point here is the big increases of world wealth is happening. Huge increase of world wealth. Capgemini and Merrill Lynch put out a very interesting report each year called the World Wealth Report. The latest data is 2006 to 2007. This is 1 year. Look at those increases. 14.5% to almost 23% across all those countries in just 1 year of new millionaires. That's the definition of high net worth individual. Ultra high net worth individual is 30 million and up. High net worth individual is 1 million and up. So in 1 year, in India and China and Brazil, 19 to 23% increase in 1 year in new millionaires. So what are they doing with their money? There's excess cash around the globe. They're going to invest it in the U.S. But what's interesting at this time is money's coming into the U.S. in the early 2000s at a time when interest rates were falling. Why were interest rates falling? Because the Federal Reserve was cutting the discount rate, cutting the federal funds rate because of the aftershock of 9/11 to mitigate the impact of 9/11. All of this at the same, so you got money coming in a low interest rate environment, looking for alpha. Can't find it. What do? Create new products. Wall Street started emphasizing the development of new products. The feeding frenzy began with no understanding of the risk underneath these instruments. Hedge funds, real estate, securitization. By the way, the word securitization, a very popular word. Proliferation of private equity funds, venture capitalists, natural resources, commodities. All these things started to inflate in terms of activity. And the last one is credit default swaps. And the huge success of credit default swaps, based on Dr. Lee's formula, by the way, and again, keep in mind, he's modeling activity of credit default swaps. He's not modeling actual behavior patterns. He's modeling the behavior patterns of the traders, which he thought correlated perfectly with the underlying behavior patterns of the risk factors. which gave, therefore, a false sense of strength to all those other categories. So all those other categories, from hedge funds to venture capital, are operating as if we're in great shape, not understanding the nature of the game behind credit default swaps. So Wall Street creates all these new products, structured products, mortgage-backed securities, credit default obligations, subprime mortgages, etc. Securitization, real exploitation of an investment tool, particularly in the mortgage arena. Look at these stacked bar charts. The Alt-A's, which are the clear box, refer to alternative A paper, considered riskier than A paper. And no documentation loans also, both less risky than subprime mortgages, but not prime mortgage paper. And these proliferated in the early 2000s up to about, they peaked in 2006, promoted largely because of the ownership society, the ownership issue. We want to own a home. Everyone wants to own a home. So there was broad participation. They needed cash. They needed to do something with it because the world was demanding the world was demanding alpha. And because of the fact that alpha was not going to come out of normal stock trades, they had to create new products. Commercial-backed securities and commercial real estate credit default obligations, in those green bars. That's the commercial side, for which not much has been talked about. There were three key assumptions that would keep this going. First, housing keeps appreciating. Second, refinancing continues. And third, the 5% default rate holds. They all fell apart. All three key assumptions underneath the dynamics that were going on. Why? Because of the financial grade enabler. Credit default swaps. Warren Buffett refers to them as derivatives, weapons of mass financial destruction. Basically, it's an insurance policy on the asset not owned by the buyer. I buy an insurance policy on your home, let's say, in the hopes that you can't make your mortgage payments. That's what a credit default swap is. What did that do? Dynamically, credit default swaps grew up to $62 trillion since 2001, 5 times the size of the U.S. economy. 5 times the size of the U.S. economy. What's this do to our wheel? Heats it up some more. New alternative assets, more alternative assets were being created. That increased the wealth effect, creating more wealth. So what's happening? Housing prices are going up, Case-Shiller index, fueling the demand for more alternative assets. There's an internal loop here. The stock market's taking off again from 2002 on. And what are we doing as consumers? Back to the beginning, borrowing more money, reinforcing. What did we create here? 2 bubbles, an asset bubble and an export bubble. And bubbles don't deflate. What do bubbles do? They burst. Now, we don't have time to go through all the dynamics of what led to this, but this is a broad, if you will, perspective, and a logical perspective of how all these things hang together.